Like and subscribe to my channel and click the bell icon to get new video updates.
The Silicon Valley bankruptcy and the imminent recession. Blame the Fed. The big market-moving event of the week was supposed to be Friday's jobs numbers, but those numbers were barely mentioned in the financial media, as they were overshadowed by the second largest and totally unexpected bank failure in U.S. history, i.e., Silicon Valley Bank. The real problem here, and something that will be answered in the next few weeks, is whether or not this was a systemic event or a one-off event, because they have been a lender to the tech sector, especially to some tech startups. Commentators concluded that this was a one-off event. In fact, CNBC reported on Wednesday that SVB was a well-capitalized bank looking to raise capital. Within 48 hours, a panic sparked by the very venture capital community that the SVB had served and cared for the 40-year run of the bank. The WHO is relevant here of uninsured deposits. As of 12/31/22, of the $175 billion in deposits, $150 billion was uninsured. The rush for deposits appears to have come from companies whose deposits were significantly uninsured. Events like this are creating fear among the public, particularly among depositors with large uninsured balances. It is the bond portfolio. When a bank suffers large deposit withdrawals, it either has to borrow money from another bank or from the Fed. When the bank reaches its credit line, it must sell bonds from its portfolio. Before March 2022, bond yields were tiny and have been since the end of the Great Recession. The Fed, had kept interest rates near zero until they decided to embark on their fastest run since the early 1980s. Because of the long period that interest rates have been low, banks have had to buy long-dated bonds to earn any type of return. When interest rates rise, longer duration bonds suffer much greater price losses than shorter duration bonds. And when interest rates rise spectacularly fast, we don't think SVB is a loner when it comes to the value of their bond portfolios. It has been a year since the Fed